America is sitting on $39 trillion in national debt right now. That number just crossed $39 trillion as of March 2026. The printer never actually stopped. It just got quieter. And while everyone was distracted by rate cuts and stock rallies, the financial foundation beneath every American household kept cracking. This is not a drill, and these are not opinions. These are numbers. If you care about your money, stay right here for this one. And if nobody has told you the truth about what is happening yet, hit subscribe to Finance Rewind right now before we go deeper, because what is coming in the next few minutes will change how you see money. Let us start at the very beginning of this modern money disaster. In January 2020, the Federal Reserve's balance sheet sat at $4.1 trillion. By June 2022, that balance sheet had exploded to $8.9 trillion. That is a $4.8 trillion expansion in less than 30 months. To put that into plain English, the Fed created nearly $5 trillion, not from productivity, not from economic output, not from real wealth creation. Simply created, digitally, by purchasing government securities and mortgage bonds. That is how quantitative easing works, and most people never understood the cost. The M2 money supply, the broadest measure of dollars in circulation, tells the story. M2 soared by more than $6 trillion between 2020 and 2021 alone. That single-year jump of 26.9% in February 2021 was a historic record. Never in American history had the money supply grown that fast in that time frame. When you flood an economy with $6 trillion new dollars without matching output, you do not create prosperity. You create competition for the same amount of goods. And that competition has one name that every household now knows too well. Inflation hit 9.1% in June 2022, the highest reading since 1991. That was not a market accident or a supply chain coincidence in isolation. That was the mathematically predictable result of unprecedented money creation. Eggs, rent, gas, groceries, everything Americans buy every single day exploded. Grocery prices since 2020 are roughly 26% higher on a cumulative basis. That means your dollar buys about 26% less food at the same store. Your paycheck did not grow 26%. Almost nobody's paycheck did. And that gap between your income and your costs is the real inflation tax. Now here is where the story gets even more uncomfortable for everyday Americans. The Federal Reserve spent years telling the public inflation was transitory. The word transitory was used repeatedly through 2021 to calm market anxiety. But transitory was wrong, and policymakers eventually admitted as much publicly. By March 2022, the Fed began hiking rates with more urgency than in decades. They hiked 11 times between March 2022 and July 2023, the most aggressive cycle. The federal funds rate peaked at 5.33% in August 2023 as a result. That rate hike cycle was the most aggressive Fed tightening since the early 1980s. But here is the brutal irony that most financial media glosses write over every time. Higher rates did not erase the money already created. It was already in the system. Once you print $5 trillion into an economy, you cannot simply unprint it. You can make borrowing expensive, but the dilution of purchasing power has already happened. Every dollar you held in savings in 2020 quietly lost purchasing power year after year. And the people who felt that most were the ones with money in savings accounts. Fixed income workers, retirees on fixed pensions, middle-class savers with bank deposits. These are the Americans who received no bailout, no hedge fund protection, no asset windfall. They simply watched the real value of their savings erode with every passing quarter. Meanwhile, the national debt compounded the problem at a scale that is hard to grasp. The debt crossed $36 trillion in early 2025, according to Treasury data. By October 2025, it had already pushed past $38 trillion, a new record. As of March 2026, the U.S. national debt stands at approximately $39 trillion. That is 122% of the entire U.S. gross domestic product, when measured properly. To put it differently, America owes more than it produces in an entire year. The Congressional Budget Office projects debt hitting 120% of GDP by 2036. And without policy changes, that trajectory only accelerates further into the future. But the debt itself is not even the most alarming part of the current story. The most alarming part is what it now costs to service that debt every single year. In fiscal year 2025 alone, the U.S. paid $970 billion just in interest payments. Let that number sit with you for a moment. $970 billion in 1 year. That is $970 billion that bought no roads, no schools, no defense capability, just interest, pure cost of carrying debt accumulated by decades of overspending. That $970 billion in interest surpassed what America spent on national defense. The U.S. spent $917 billion on defense in fiscal 2025. Interest beat it by $53 billion. Interest also outpaced spending on Medicaid at $668 billion by a staggering margin. And the Congressional Budget Office projects, that number hits $1 trillion in 2026. America will spend $1 trillion paying interest on debt in fiscal year 2026. $1 trillion every year just to stay current on the national credit card balance. That is $2.8 billion per day in interest payments flowing out of the Treasury. In CBO projects, that daily cost will rise to $5.9 billion per day by the year 2036. Every single American household's share of that interest bill is roughly $7,300. That is more than the average American household spends on healthcare annually, more than gasoline, clothing, and education combined for the average U.S. family. And this is where the cycle becomes a trap that is genuinely difficult to escape from. More debt requires more borrowing to pay interest on the original borrowing. More borrowing adds more debt, which requires even more borrowing the following year. The Committee for a Responsible Federal Budget has a term for this: fiscal dominance. When interest costs grow faster than revenue, the government faces impossible choices. Print more money to cover the gap, which accelerates inflation directly for consumers, or cut essential programs drastically, which creates economic pain on the other side. This is the box that decades of money creation and deficit spending have built around us. The Federal Reserve's balance sheet had started coming down from its 2022 peak. The process known as quantitative tightening began in June 2022 with monthly caps. The Fed reduced its securities holdings by approximately $2 trillion total. But that still leaves the balance sheet near $6.85 trillion as of early 2025. That is still nearly 70% larger than it was before the pandemic began. The money that was created does not disappear just because the printer slows down. It remains circulating through the system, embedded in prices, rents, and wages. And this is precisely where the situation becomes even more dangerous going forward. Because the Fed is now facing pressure from multiple directions simultaneously right now. Interest rates were cut starting September 2024. The first cuts since September 2021. Rate cuts are stimulative. They encourage borrowing, spending, and economic expansion. But inflation had not fully returned to the Fed's 2% target at that point. Inflation was still running above 2% heading into late 2024 and beyond. Cutting rates while inflation remains above target is a historically risky policy move. It signals to markets that the Fed may prioritize growth over price stability now, and when markets believe price stability is no longer the top priority, things shift. Inflation expectations become unanchored, and that is when the second wave begins building. Yale's Budget Lab analyzed exactly this risk with hard data in a recent publication. A permanent primary deficit increase of just 1% of GDP raises inflationary pressure. That pressure translates to a purchasing power loss of $300 to $1,250 per household. And after 30 years, the cumulative loss per household reaches $16,000. That is not a theoretical model. That is the trajectory the U.S. is currently on. The U.S. deficit in fiscal year 2025 was $1.8 trillion, 5.9% of GDP. That is nearly double the 3.8% average deficits have run over the past 50 years. The CBO projects the deficit reaches $1.9 trillion in 2026 and grows steadily from there. Deficits from 2026 through 2035 are projected to total a staggering $23.1 trillion. That means the U.S. government plans to borrow $23 trillion over the next decade. Every dollar of that borrowing adds to the debt that future generations must service. Every dollar of that borrowing creates additional pressure for money creation over time. And every dollar of that money creation chips away at the purchasing power of savings. The American Rescue Plan of March 2021 added $1.9 trillion in deficit spending. Shortly after that signing, inflation began climbing toward its 40-year high of 9.1%. The House Budget Committee directly linked that spending to the inflation surge that followed. Inflation cost Americans an estimated $8,000 in cumulative real income since then. That is, money that working families never got back, lost permanently to rising prices. Now let us talk about what inflation actually looks like inside the average American home. The Bureau of Labor Statistics tracks it clearly with Consumer Price Index data regularly. Grocery store prices rose 2.1% year over year through January 2026 alone. But shelter costs, rent and housing, rose 3% in that same measured period. Utility gas was up 9.8% and electricity climbed 6.3% year over year. Medical services rose 3.9%, meaning healthcare got more expensive simultaneously. These are not small rounding errors on a spreadsheet somewhere inside a government office. These are the real costs that drain real dollars from real families every single month. And the people most exposed to these costs are the ones least able to hedge against them. Lower income households spend larger shares of their budgets on food, shelter, and energy. These are precisely the categories where inflation has been the most persistent and stubborn. Higher income households own assets, real estate and stocks, that inflate right alongside prices. This is how monetary policy creates wealth inequality as a structural mathematical outcome. It is not an accident, and it is not just politics. It is the arithmetic of asset ownership. The top 1% gained $6.5 trillion in net worth between 2020 and 2022. Meanwhile, 160 million working Americans absorbed inflation's full weight with no hedge. Their bank accounts grew numerically, but shrank in real purchasing terms simultaneously. This is the hidden tax, the one that requires no congressional vote to be imposed. No senator stands up and says, "We are going to reduce your purchasing power by 9%. It just happens through the mechanism of money creation and the prices that follow it. China holds approximately $756 billion of U.S. Treasury debt as of mid-2025. Japan holds over $1.1 trillion, the single largest foreign holder of American debt. Foreign holders own roughly $8.5 trillion worth of U.S. government securities. If confidence in U.S. fiscal management erodes globally, the cost of borrowing rises further. Rising borrowing costs mean bigger deficits, which mean more debt, which means more inflation risk. This is the spiral that every serious economist is quietly watching with increasing concern. The dollar has lost roughly 96% of its purchasing power since 1913 historically. That decline accelerated dramatically after 1971, when the gold standard was officially abandoned. But the speed of dilution since 2020 represents a compression of decades into just years. When 27% of all dollars in existence were created in a single year, that matters. When prices at every level of the economy reset upward, they rarely reset back down. Deflation, a general fall in prices, is actually extremely rare in modern economies. Prices are sticky upward, meaning once they climb, businesses rarely volunteer to lower them. So the 26% cumulative rise in grocery prices since 2020 is essentially permanent now. Your dollar simply buys less, and that is a structural reality no rate hike fully reverses. The Congressional Budget Office projects debt reaching 175% of GDP by 2056. That is not a forecast from a fringe economist on a podcast. It is the official government model. At 175% of GDP, the interest burden alone would crowd out virtually all discretionary spending. Social Security's trust funds are projected to be depleted within approximately 8 years. Medicare's trust fund faces depletion within 11 years, based on current trajectory models. Without reform, those programs face automatic benefit cuts of 24% for Social Security alone. The GAO confirmed in February 2025 that America's fiscal path is officially unsustainable. That word, unsustainable, came directly from the government's own nonpartisan auditors. Every working American, every retiree, every family saving for a future is inside this system. Understanding it is not optional if you want to make decisions that protect your financial life. The money printer did not stop. It just changed speed and the public stopped watching. Debt at $39 trillion, interest at nearly $1 trillion annually, inflation still above target. These are not fear tactics from a financial influencer. These are audited government figures, and the only people who profit from the public not understanding this are the ones already hedged. The middle class, the working class, the savers, they carry the weight every single time. If this video opened your eyes to what is actually happening inside the U.S. financial system, give this video a thumbs up and share it with someone who needs to understand this clearly. Subscribe to Finance Rewind right now, because this story is far from over yet. And drop a comment below. What do you think happens next when the debt hits $40 trillion?